In this video, I hope that I'm wrong. I love research and I've got a lot of different alarm bells that I want to share with you today that I've been noticing within the US markets. Initially small cracks, but this has now got to the point where I think everybody should be paying attention. So stay tuned. We're going to be talking about what are all the alarm bells that are ringing and not positively for the US markets, and something that you should be taking into account whether you're a day trader, whether you're a financial advisor, whether you are involved in the markets in whatever aspect, or if you're just a regular Joe with a mortgage, then check this out. The first alarm bell that I want to talk about is the office CMBS delinquency rates. It has jumped to 11.8%. This is the highest reading that we have seen on record. And overall, that tells a telling story about history. So what does this mean? This means that commercial properties in the US are behind on their payments for their offices. This is a report given by TREP. This is an alarm bell. You can see on the chart the different outlooks that have happened previously when delinquency rates got high. I've previously mentioned to my weekly students that I talk to every single Thursday live that this was the sort of first thing that I wanted to start monitoring going into Q4 as well as going into Q1 of next year. It initially did dip slightly down, but then it's come straight back up again. So this is an area that we basically opened the can, because usually when these delinquency rates get high, we usually see the credit markets tighten up, and then you see fear and panic start setting in, and this is then followed by a market crash. So following that, I wanted just to see whether the credit market was getting tighter within commercial property or whether it was the wider market. And the reason why I wanted to do that is because obviously ever since the pandemic, a lot of people prefer working remotely. Maybe the demand isn't there for commercial properties. And I just wanted to make sure it wasn't just a single area. So I started looking at US credit card delinquency rates. And this is also the highest level since 2010. Which is a huge alarm bell. You can see the chart up here. The source is Federal Bank Reserve of New York. These aren't just random posts on social media. They are verified sources, and it's something that we should be looking at. The average credit card user in the US, 12% of them are now 3 months or more behind on their payments. This is an alarm bell in its own right from a consumer credit debt point of view, but we've also seen this in the commercial property space. So there's 2 alarm bells around credit. And then off the back of that, I read the news quite a lot, and then I saw that the New York Fed set up meetings with some of the Wall Street banks over credit. And overall, they wanted to discuss key lending facilities and what that looks like at the moment, and that in itself is an alarm bell. The Fed is clearly worried about money strains on the market, and rightly so, with the consumer credit card debt and also the commercial property aspect. But what else is there that is also flashing alarm bells for us? And then suddenly, out of nowhere, the Bill Gates Foundation dumped 65% of its entire Microsoft shares. Just to put that into perspective, that is $8.8 billion worth. Why would he sell that amount if he wasn't nervous about the market? Another interesting thing that I was just looking at in general, this was the US housing market. There are 875,000 homeowners now owe more money on the debt on their property than their house is even worth. This is the highest level seen in 3 years, and again, is something that I'm not taking too seriously right now, but it's definitely something that I'm writing down in my little book and monitoring, because it is something that makes me nervous. So something else that I've noticed as well is that the US stock market valuations have never been higher in history. So I'm just going to pull this chart up for you here. The stock market has never been richer over more than 100 years. Trailing PE, forward profit to earnings ratios, CAPE, PB, PS, EV, EBITDA, Q ratio, market cap to GDP, the average percentile, and full history. We have never been valued higher within the US markets. Now, this is a screaming alarm bell that the profit to earnings ratios now, percentage-wise, is the most it's ever been. That in itself is a huge alarm bell because it means that the US markets are so heavily overvalued, let alone weighted to a very small percentage of major cap shares. And then getting back to debt, auto cars within the US has hit the highest level in history as well. So more than 6.65% of individuals that have finance on their cars that pay it down monthly owe more than 60 days of payments on their cars. So we can really see a stretch here coming from not only consumers, but also from business owners as well. Next, 71% of people believe that US unemployment is going to go higher in the next 12 months. This would be the highest level within 45 years. So this to me is really screaming that there is a recession, and we're very much close to being in that recession right now. There's obviously a lagging effect that we will see in the markets, and I definitely think that we could see this happening going into Q1. If we want to carry on and we keep backing this up even further, we can also see that corporate bankruptcies. This is on track to be the worst year since 2010, which is just after the recession. So let's take that into account as well, that corporate bankruptcies is on track for its worst year since 2010. And usually the first place that we see the cracks is usually not really within credit. We usually see it within small cap companies. And this might be because of the tariffs in the US having an effect on them, and they're either having to put their price up, looking less competitive, or they're having to suck up those costs themselves. So something else that we look at is also what we call zombie companies. So let me bring up a chart for you just now. So zombie companies are businesses unable to cover their debt payments. This has reached the highest level in almost 4 years. As interest rates stay higher for longer within the US, this is only going to get worse. We saw the Federal Reserve also come out and say that a December cut is very unlikely. So this is only going to fuel everything that I've just discovered within the credit markets even more. On top of that, we have got experts within the market, such as Warren Buffett, who has sat on over 20% of cash on their portfolio, the highest that they have in their history as a fund at Berkshire Hathaway. We've also got Peter Thiel, who has sold all of his Nvidia shares. We've also got, maybe arguably whether we take him into account, Michael Burry is shorting Nvidia and Palantir. These are all areas that I am focused on. We are seeing institutional outflow of money, and we're still seeing regular retail money coming into these markets. So these are things that we should all be looking at, but everything that's within this video of my research is pointing towards recession, and it's pointing towards a strong market correction within the US markets. I really hope you've enjoyed this video. If you want to find out more about how you can get qualified and find out all of this information, where we do the research, what and how the economy works, and how you can also do this whilst being instantly funded with a 100K account, then make sure you fill out my form in the description below about how you can get qualified, and ultimately if you can make 0.5% per month on your account over 12 months, how the qualification is pretty much free. So look forward to seeing you guys in the next video. Please get in the comments with whether or not you think a US recession is inbound, and what's your thoughts on all of these data points. I look forward to seeing you in the next video. Make sure we hit that like, make sure we hit that subscribe button.